morning. I come with the next module, module 7.3. See, 7.1 I have explained the theoretical concepts for computation of house property. 7.2 I have explained how you calculate expected rental value, gross annual value, net annual value, annual rental value. So we have explained with the help of problems. Now this module is very important because income from house property, two types of problems you have to see. See, one is income from let out house property, one is income from self-occupied house property. So there is a clear distinction. Income from let out house property, 30% standard deduction we will allow. So that you have to remember, and interest on borrowed capital. So the limit and all I have explained clearly in the first module, whatever be the limit. So I have explained it. So here you have to remember that this module 7.3, you will learn income from computation of let out house property. So the different adjustments I will explain clearly, and then you have to remember this module. So that will be, then we will do module 7.4 will be computation of income from self-occupied house property. Then module 7.5 is pre-construction period interest. Now 7.6 is full problems including let out house property, pre-construction period interest and self-occupied house property. So this you have to remember. So we are going to learn this income from computation of let out house property. First problem, compute the income from let out house property from the following information. So municipal rental value 1,80,000, rent received during the year 2,40,000. Municipal taxes 50% paid by the tenant. Please remember that this is one adjustment you have to remember. Municipal tax paid by the tenant is not allowed. Only paid by the owner is allowed. Now expenses incurred on repairs by the owner 30,000, by the tenant 30%, and collection charges 10,000. Please remember that the landlord will be giving, or the assessee will be giving so many expenses just to reduce the tax liability. We will not allow any of these expenses. Flat 30% standard deduction under section 24 we will allow. So that is the only deduction allowed. So here you have to remember that expenses we will not consider, 30% standard deduction we will allow. Now date of completion of the house is 1/6/2018. So from June onwards only they got the, so 1/6/2018, last previous year it was completed. So this year it was fully given on rent. So now we will do this problem. Table showing the computation of income from let out house property. So municipal rental value 1,80,000, actual rent received 2,40,000. So between A and B, whichever is high is the annual rental value, that is 2,40,000. Now from this you have to reduce the municipal taxes paid by only by the owner. Paid by the tenant is not allowed. So 30,000 is allowed. So you will get net annual value. So net annual value 2,40,000 minus 30,000, it's 2,10,000. Now deduction under section 34. This will not be there in the question. You have to remember that if it's let out house property, 30% of net annual value you have to allow. So here remember in module 1 I have explained what all deductions are allowed for let out house property and self-occupied house property. So standard deduction 30% of 2,10,000, it's 63,000. So income from let out house property is 2,10,000 minus 63,000, that is 1,40,000. Now we are moving to the second problem. Mr. A submits the following details about the house property he has given on rent for commercial purposes. Compute the income from let out house property. So letting out can be residential house property or commercial, residential purpose or commercial purpose. So this is for commercial purpose. So municipal rental value 1,44,000 per annum. Fair rental value 1,48,000 per annum. Standard rent 1,60,000 per annum. Actual rent 1,92,000 per annum. Municipal taxes 14,400. Now interest on loan taken for the purchase of the house. This is also another deduction allowed under section 24. Now the solution, municipal rental value, fair rental value. Whichever is high we have to take, that is 1,48,000. You have to compare with standard rent, whichever is less then you will take. We have learned in computation of net annual value, that's the last module I have explained all these computations. So 1,48,000 you will get. Now you have to compare with actual rent. So with the actual rent and this expected rental value, whichever is high, we will take. So that is the annual rental value. It is 1,92,000. Now less municipal taxes. Remember, municipal taxes, if paid by tenant, it's not allowed. Paid by owner only allowed. So 14,400 you will reduce. Now you are getting net annual value. So net annual value is 1,92,000 minus 14,400. You are getting 1,77,600. Now less deductions under section 24. Standard deduction, it's not mentioned anywhere. You have to remember, if it's let out house property, 30% of net annual value you have to allow. That is 53,280. Now interest on loan taken for construction, it's given that 45,000. So the income from house property, 1,77,600 minus 53,280 and 45,000. It is 78,330. Now problem 3, Mr. G, 6 problems we are doing in this module. So problem 3, Mr. G has 2 flats of equal dimensions which are given on rent of rupees 10,000 each. Following expenses are incurred in connection with the house properties. Compute income from let out house property. 2 flats is giving. So municipal taxes at the rate of 10% of municipal value. So municipal tax value is directly not given in the problem. You have to calculate. So 2 lakh is the municipal value. 2%, 10% of that will be the municipal tax. Fire insurance premium, 2% of municipal value, 2 lakhs. Rent collection charges for the first house, 6,000. Not allowed because 30% standard deduction we are allowing. Repairs and alterations not allowed, 10,000. Interior decoration charges not allowed. Legal charges for recovery of rent for the first flat not allowed. Interest on loan taken for construction of flat. This is allowed, 42,000. Now, conservancy tax in addition to municipal tax. Conservancy tax, you have to remember that this also is allowed under section where it to be deducted from annual rental value. See, conservancy taxes, see some within the market area and all small lanes and all, that also will be maintained by the municipality. See, 100 feet road and all, they will be small lanes, 10 feet roads, that small lanes inside the market and all, that also will be maintained by the municipality of that area. So they call that tax called conservancy tax. So that is also allowed to be deducted along with municipal tax. So you have to remember that conservancy tax can also be deducted from annual rental value to get the net annual value. Now, all the 3 columns if you provide, we can calculate that both values together. That is municipal tax is 2 lakh. Municipal rental value. Municipal rental value, this is not municipal tax. Municipal rental value is 2 lakhs. Actual rent is 1,20,000. That is 10,000 into 12. Then actual rent, whichever is high we will take. Annual rental value or municipal rental value. So this value 2 lakh is the higher value. Now you are reducing municipal taxes and conservancy tax. Municipal tax is 10% of municipal value, municipal rental value, and conservancy tax is 2%, 3,000. Conservancy tax is 2%, that is 3,000 for 2 houses. So that is we have to divide by 1,500 each. So 2 houses it's 3,000. So 1 house it will be 1,500 each. 1,500, other house also 1,500. So annual rental value, you are reducing municipal tax and conservancy tax, you are getting net annual value. Net annual value is 1,78,500. Now we have to calculate the income from let out house property. So we are computing in the next table, that is net annual value. These values are 1,78,500 less deduction under section 24. Standard deduction 30%. So 53,550. Interest on loan taken for construction. First value is nil, second value is 42,000. Only for the second flat, interest on loan is there, 42,000. Income from a let out house property. So first flat it is 1,24,950. Second flat is 82,950. So please remember that this problem, what is the new adjustment we learned? That is conservancy tax can be deducted from along with municipal tax from annual rental value to get the net annual value. So total income from house property 1,24,950 plus 82,950. It is 2,07,900. Now problem 4. Compute income from let out house property of Mr. A from the following particulars. Rent realizable from the property. So monthly rent is 27,000. Total for the year it is 3,24,000. Municipal taxes to be paid by the owner. Owner can be allowed. Paid by the tenant is not allowed. Property is on a leasehold land and the actual annual lease rent 30,000. Rent collection charges, it's not allowed because we are giving 30% standard deduction. Property was mortgaged for taking a loan for his partnership firm and the amount of loan is 5 lakh at the rate of 10%. So that loan amount is 5 lakh. It is not allowed because this, if we will allow deduction only if the loan is taken for construction of the house property. This loan is taken by mortgaging the property for a partnership firm. That is not allowed. This property was vacant for 2 months and the rent per month was 27,000 per month. So vacancy allowance also we have to consider. Now table showing the computation of income from let out house property. Rent receivable 3,24,000. Now vacancy allowance is there 2 months. It's already given in the question. 54,000 you have to reduce. Actual rent received is the annual rental value because other values are not there. 2,70,000. 3,24,000 minus 54,000 you will get 2,70,000. Now less municipal tax 9,000. It's paid by the owner so we can allow that. Net annual value 2,61,000. Less deduction under section 24 78,300. That is standard deduction. Now in only standard deduction is allowed because I told you the loan is taken for partnership firm, that is not allowed. So income from let out house property 2,61,000 minus 78,300. You will get 1,82,700. So this deduction you have to remember that this problem you learn one adjustment, that is if the loan is taken only for the construction of the house property, then only you will get the deduction. So this is partnership business loan is not allowed for this computation. Next problem. The particulars of a residential house completed on 31st May 2018 are given below. Compute the income under the head income from house property. Rent is 80,000 per month. Municipal taxes paid is 18,000. Ground rent 500. Insurance 800. These two expenses not allowed because it will all include in the standard rent. Interest on loan taken for construction of this house property. This is allowed. Collection charges paid, not allowed, 300. Unrealized rent of earlier years, condition satisfied, 20,000. So this also we have to consider. SSC mortgaged the house for rupees 3,60,000 to meet the expenses of his daughter's marriage. That is not allowed because only for the construction of the house property, whatever loan is taken is only allowed. Compute the income from house property. So table showing the computation of income from let out house property. Rent received 80,000 into 12, 9,60,000. Unrealized rent you have to reduce. So this unrealized rent 20,000. So then you are getting gross annual value, that is 9,40,000. Now municipal taxes you have to reduce. Net annual value, annual rental value minus municipal taxes you will get net annual value 9,22,000. Now less deduction under section 24. Please remember if it's let out house property, always standard deduction you have to reduce. So that is standard deduction is 3,76,600. Interest on loan taken for the construction of the house property 1 lakh. So total deduction allowed is 2,76,600 plus 1 lakh 3,76,600. Income from let out house property is 9,22,000 minus 3,76,600, 5,46,000. Now last problem for this module. Mr. R has income from house property and submits the following information. Compute the income from house property. Gross rental income of the year after deducting the following item. So here you have to remember, see this is the gross rental income. They have deducted all these items. So you have to add back these items to get the actual rent received. Depreciation 24,500. Lift maintenance charges 7,500. Municipal taxes 10% of municipal value. Municipal value 1,50,000. Value is 15,000. Vacancy 10,000. Repairs 18,000. Salary to security staff 1,000. Bank commission 500. Legal expenses to collect rent 8,000. Salary of gardener 1,200. Now we are going to do the problem. All the income computed by the SSC is 1 lakh. Now we have to add the deductions he made. Depreciation, lift maintenance charges, municipal taxes, vacancy, repairs, salary to security staff, bank commission, legal expenses for the recovery of rent, salary of gardener. So actual rent is not 1 lakh as computed by the SSC, it is 1,85,700. Now we have to do the computation of income from house property. Net annual value first we will calculate. Then we have to do the computation. That will be the next slide. So actual rent is 1,85,700. Less cost of common facilities. Lift maintenance 7,500. Salary to security staff 1,000. Salary to gardener. So these three expenses. Common facilities. So that is we are reducing. So your 9,700 is the total thing. Total common expenses. So real rent is actual rent minus this common facilities. So 1,76,000. Now real rent 1,76,000 or municipal rental value. This is given in the question because municipal taxes is given as 10% of municipal value. So that is whichever is high. So it is 1,76,000. Now vacant, the house was vacant. So loss due to vacancy is 10,000. So here annual rental value is 1,66,000. 1,66,000. Now annual rental value 1,66,000 less municipal taxes 15,000. So you will get the net annual value 1,51,000 less standard deduction under section 24. Standard deduction is 1,51,000 into 30 by 100, 45,300. Now income from let out house property is 1,05,700. This is the module I want to explain about computation of income from let out house property. So please remember that we have learned the adjustment for conservancy tax is can be reduced from annual rental value. Municipal taxes also we can reduce. Municipal tax value may not be there directly given in the question. Sometimes it will be percentage of the municipal value. Municipal rental value. You have to calculate that. Then you have to remember only the taxes paid by the owner is only allowed. So if it's municipal taxes paid by the tenant, it's not allowed. So that deduction also you have to remember. So if the SSA has deducted the common facilities from the rent he has received, we have to add back those items to get the actual rent received. So these are the adjustments we learned, and remember that standard deduction will not be there in anywhere mentioned in the question. You have to remember that if it's a let out house property, 30% of net annual value you have to allow as deduction, standard deduction. So that is the reason why we are not allowing all the expenses claimed by the SSC. Ground rent will be there, fire insurance will be there, collection charges will be there. So many expenses they will claim. So that we will not allow. Only 30% standard rent we will allow, and standard deduction we will allow, and that will include all the expenses. So that is the computation, and I hope that the computation is clear to you. This is very, very important because let out house property and self-occupied house property you have to learn. Then only we can compute the complete computation of house property income. So one problem if you get in section C, it will have let out house property and self-occupied house property and pre-construction interest also. So this is very important. You have to learn this, then only you can do that. So wishing you all the best, and give me your suggestions and feedback, and hope you are keeping safe and healthy. Thank you for watching, and please forward this to your contacts because this I told you, this I have explained it in a systematic way and in a simple way. So the students will find it really easy, and this year you can learn this subject along with me. So throughout the country I want to get my students, and this is how I will also get the happiness. Thank you for joining and give me your valuable feedback.